Hi, this is Randy Finney with Right Side of the Chart, and this is a market wrap for the week ending Friday, October 26, 2018. All right, so let's take a quick look at how we close the week and what to expect going forward. The big thing is we had those big three earnings reports last night are now out of the way: Amazon, Alphabet, and Intel. So that clears the path to let the markets do what they want to do as far as the technicals and supply and demand goes, without any big surprises. Sure, we're still in the thick of earnings season. And we still have the biggest earnings report coming up. Apple next Thursday after the bell. Apple's the largest company in the world, largest publicly traded company. It's the largest component of both the S&P 500 and the NASDAQ 100. So SPY and QQQ. But they don't report until Thursday after the bell, so we don't have to worry about any knee-jerk reaction in either direction until Friday, really. So that gives us a clean playing field next week, relatively speaking, and of course anything can happen. But so let's summarize what happened this week. We had finally we have those clear sell signals I've been talking about for quite some time, wanting to see a solid weekly close below the primary uptrend line here. This is a QQQ weekly chart. That's a primary uptrend line that goes back to 2015. I have a longer term bull market. It's really, you can tie in there. It's right at, I'll show you a longer term bull market uptrend line in a second, but that's really the one I've been watching. And uh, we had that stick save a few weeks ago where we broke it intra-week, parked back above it as I had expected we would. Then the following week we bounced right off that 40-week moving average, which is the same as a 200-day, and that's a key moving average, and parked it right on the trend line. And then this week you can see we have that, what I like to say, a solid and impulsive candlestick down and a solid weekly close. So that puts those very key supports in the rearview mirror now. Nothing is absolute in trading. Anything is possible. Those levels could be recovered next week, 2 weeks from now, a month from now. But the odds are pretty low in my opinion. So at best, support once broken becomes resistance. So at best, you'd look for a back test. At least that would be an objective short if we rallied back up to that level anytime soon, and maybe you'd get another short entry there. I still favor more downside. I'll make that clear. I've been maintaining, for a while now that we'll most likely retest these lows back from earlier in the year, back from early 2018, at some point before the year is over. Now we're heading into the end of October, so we only have 2 more months to do it. I think it'll probably happen next week. I think there's a good shot if my analysis continues. All the check boxes that I've been waiting for to be checked have been checked. Another one this week with this big red close, weekly candle close. So if that continues, then I think we get probably a flush out move next week, and possibly another 2 weeks, but I think it'll be quick. I think there's a good shot we'll hit everything next week and be able to start looking to cover all the shorts and go long, reverse just some nice long trades for a bounce trade. But we'll see. And as I've mentioned many times, that when you have a key level and all eyes are on it, I'm sure once we get close to it, if they're not talking about it already, the other pundits out there talking about a test of those lows. One of two things happens when all eyes are on a level. You either reverse just shy of that level, or you undercut it to blow out all the stops and just keep everybody on their toes. Rarely do you come in and make a perfect test. Sometimes, but just keep that in mind. So my point is, there might be a little leeway there. Okay, that was QQQ. This is SPY, the S&P 500 tracking ETF. What we're focusing on here, what I have been, is this long-term trend line. This is our bull market trend line. This comes off the March 2009 lows. Well-defined trend line, define the bull market. We had this minor uptrend line, the yellow one, which is comparable to that trend line I just showed you on QQQ a minute ago. It comes off the in SPY and everything else. A lot of the sectors in the S&P 500, like tech sector, everything else, they come off the 2016 lows. And for all intents and purposes, that one on the NASDAQ 100 does. QQQ had a mini crash back in 2015, and it happens to coincidentally pick up there. But that was the trend line. So the SPY broke that trend line back in that second correction we had earlier in the year, back in March. Came in, hit the long-term bull market uptrend line as well as that key 40-week moving average, and back tested since then, and then finally rolled over. So we have once again on both the two indexes that I put the heaviest weighting on, are the S&P 500 and the NASDAQ 100. We have a solid red close. So, we had that stick save a few weeks ago. They parked it right back on the trend line and the 40-week as I expected. The following week, they closed it below the trend line and right on the 40-week. And this week, they gave them both up and clearly in the rearview mirror. So that's it. And I'm still leaning towards more downside because of that in next week or in the coming weeks. And again, anything's possible. Remember, if you followed my analysis recently, I highlighted these. There are some divergences forming on the 60-minute charts of the indexes, just about every index, SPY, QQQ. These could certainly lead to be the fuel for a catalyst for a rally, especially if we take out those downtrend lines. If you recall recently, I nicknamed these the golden downtrend lines. I have QQQ and SPY. These are the trend lines off the recent highs in early October. Very well defined, lots of reactions. I know this is busy now because I have all these little micro levels I've been trading off of, but just focus on this trend line. And a pop above it isn't a be-all, end-all. Doesn't mean we're going to the moon, but it could spark certainly a short covering rally or some buyers stepping in. So that's still a level to watch for next week. But as of now, the trend is down. And one thing I wanted to talk about is the market action. And I've mentioned this recently. This is just a clean board here. It's a 15-minute chart, goes back to early October, and as I've stated, the trend is still clearly bearish. The trend is down. Stocks have been moving lower, and what's happening here is as has been for years, the dip buyers have been stepping in on the dips, but they keep getting sold into, and the market moves lower every time the dip buyers step in. So it's at some point, we may get to where the dip buyers finally capitulate and give up. They stop stepping in, longs start to sell, and then we can get a true waterfall sell-off. We've had some very impulsive selling recently, but it's not a true. It hasn't felt like a capitulation type sell-off. So that's what I'm still leaning towards in the next week or two here, and we'll see. And I'll stay flexible. If the charts we start breaking out of some of these short-term trend lines and take out resistant levels, overhead resistance levels. We put in some bullish reversal candlesticks, things like that. Then maybe we could look for position for rally. Maybe the correction did end today or will end early next week. So we'll see. And again, I'm leaning that way. I think it'll happen quick if I'm right. One more flush out move, another. I have to quantify it for you, but I think the other day when we bounced, I was calling for another, I don't know, 11, 12% down in QQQ, so it's a little less today, obviously. But before I move away, here's just real quick on a long-term chart. This is a monthly chart. I haven't talked much about the monthly charts yet, but here's a QQQ. Now, the NASDAQ 100 is the only index. It actually bottomed everything else in the stock market, the Dow, the S&P, small caps, all that, bottomed in March of 2009, but the NASDAQ 100 actually bottomed back in November of '08. And so there's your trend line, and you can see monthly candle, we're right on it now. And longest term trend indicators are still bullish. I want to point that out. One of several that I use. It's very simple and effective. The rate of change 12 works good on SPY as well. Let me pull it up on SPY. I'll cue it in there. All right. So the ROC 12. Sometimes you can use a 13. So it'll fit. You can change the settings. It just does a great job of defining bull and bear markets, the primary trend. And right now, I showed you that those long-term trend lines have been broken. So there's a good chance that the trend we are now embarking on maybe a new bear market, or at least a drop of 20% or more. But you can look at this chart here, and this spans decades. This goes back to the great big bull market back in the early 90s. It ended with the dot-com bubble right here. And there's your bull market uptrend line. I mean, if you really step back and look at these charts, to me, they're pretty clear and simple. The markets go in trends. We have bull and bear markets. They're just natural parts of the cycle. I know some people get really charged up and offended when people talk about bear markets and wanting to trade one and looking for corrections, but it's a natural part of the business cycle. You're always going to have economic expansions and contractions, and bull and bear markets along with it. So there's the bubble that popped in '08, and this might not look like much, but these were big corrections. Remember, the S&P 500 fell about 55%, and this is the bull market up to the 2007 highs, from the '02 lows to the '07 highs. October '07, your 55% so bear market, pretty swift and over, almost before you knew it, less than 2 years. I suspect the next bear market will be much more prolonged, but that's a good thing. We'll have plenty of opportunities on the long and short side. And whether it's underway now, whether it's starting out, who knows? But I'll show you something that I use is this rate of change 12, and you can see here it just does a one bang up job of defining bull and bear markets. So when these lines are green, in other words, when it's above the zero line, you're in a bull market, a bull trend. Pretty simple. Zero false signals throughout that entire bull market. Zero whipsaw signals throughout the entire bear market. And it's not going to get you in on the day at the top or the day at the bottom because it's a slower indicator. If I turn it up to an ROC 13, it helps filter out. You can see a couple whipsaw signals. The higher you go, you can see it gets rid of those red bars. So you can play around with it, maybe up to a ROC 14, which I've just done here. Took away a couple whipsaw signals. Now you see some red here. That was actually some people out there consider this a bear market. We did correct over 20% drop in the small caps, mid caps, a lot of sectors, but the S&P 500 and the NASDAQ, at least I know the S&P 500 just missed that 20% drop by a hair. Semantics, really. We went sideways for almost 2 years, called a deer market at best. A deer market is neither a bull or a bear market. It's when stocks trade sideways. And then we had that period of consolidation, then we went up. So there it is. So you can consider those, telling you that at least the trend was bearish. Now, where are we at now? Well, I'll go back to my tried and true ROC 12 real quick. And you can see we're not far from it. There's a big red candle here. Next month, I don't know, it's possible if we have a sharp week down in the first part of the week next week and we close October, we build on these losses. Maybe that flips to bearish, and on QQQ, it's getting close. You can see this sharp drop off right there. So just be aware that we could be looking at the next bear market very soon, or who knows, maybe another leg up into next year like some have been calling for. I don't know. I'm just trading the intraday charts now, the daily charts, the weekly charts, and at this point in time, everything that I see points to more downside, quite likely in the next week or so here. But again, that rubber band is getting stretched. Let's go back to the daily charts. Let's look at the RSI. You have divergence on the RSI. We were oversold. When I say divergence, I'm referring to positive divergence. RSI has made a higher low. Markets are getting very stretched. So when you stretch that rubber band, you're increasing the odds of a snapback rally. That was a daily chart. However, we're not even close to oversold yet on the weekly chart, on the weekly RSI for QQQ. So keep that in mind. There is more room for downside. And we just may very well hit that in the next week or two, where we see another thrust down and come in and have our first oversold reading in a long time. Typically, you see those. Last time we hit that RSI oversold on the SPY was back there in 2011. Let me share another thing with you. I shared this on the trading room within the trading room today. I watch a lot of different sentiment indicators. I look at surveys. I look at put to call ratios, a lot of things like that show fear in the market. And I have not seen. I only use those sentiment indicators when they're at extremes. Yes, the VIX has been popping lately and all that, but it's certainly not at an extreme. And more importantly, the put to call ratio, whether it's the equity only put to call ratio, index only. They're not at the levels that I've seen before that indicate extreme fear. And so what I did today, I did Google search, not a Google search, Google will give you, if you type in, there's a way to go to find out hits. So I entered the term stock market crash. And here's the hits on Google for the past 12 months. And you can see that was, there it is, a week of February 4th through 10th. Remember early in the year, that first big drop off the highs? Well, that bottom, I think it was, I'm going from memory, February 8th. So that's that week, right at the peak. So back then, you had a lot of fear. The general public went crazy over searching the term stock market crash. This time around, nothing, a little blip. And it kind of jives with what I threw out there in the trading room on the site today. I asked the members because I never watch CNBC or Bloomberg. Rarely. I'll turn it on if there's an FOMC meeting or some market moving report coming out. But I just personally, it's noise to me. But I polled the some of the members on the site, and they said, yeah, it's a lot of dip. They're pretty much telling everyone to buy the dip. It's a buying opportunity, all that. So I don't see that fear yet. And until we get that fear, there's a good chance that the bottom is not in on this correction. Remember, this was just a correction. This wasn't the bear market or anything last year. This isn't 2008 meltdown. This is just that first blip. And it's not, a be-all, end-all statistic. It's just something I threw out there today. But I wanted to say that this aligns with what I'm seeing elsewhere, that there's too many doubters on this correction. And I still think there's a possibility we get that rush for the exits that I've been talking about. With a lot of unwinding of the big FANG trade, Apple, Microsoft, Amazon, Alphabet, and the big indexing trade too. All right, we'll wrap this up with just throw something out there because I threw this out for the public YouTube channel followers recently, and I'll follow up on the VIX and VXX. And this also speaks to the fear. Yeah, the VIX has spiked up, like I said, but the VIX could certainly go a lot higher. This is a weekly chart of the VIX. So you can see in the past, and we're again coming off extreme. This is the lowest ever in the history of the VIX, leading into 2018, coming into late 2017. There's the beginning of the year right down here. We've never seen the VIX that low. So that showed extreme complacency, extreme bullishness, which is often the signature of a major market top. And just to kind of put it in perspective, here's where we're at right now as we close the VIX today. And here's some of the spikes that we've had in recent years, even this is all during the bull market right here. The bear market's to the left of this chart. So don't think as much as the VIX has spiked, as much as the market has dropped, that it can't drop more. And I'm not trying to sell you on that fact that it has to happen. I'm just trying to point out simple, clear metrics that show that as much as we've come up, this would mesh with my flush out scenario in the next week or so. Another big pop up. And so going back to the daily chart, again, it was priced in, just like the markets had negative divergence going up to the high. Recently, the VIX had positive divergence going into the lows, and you can see where it hit resistance today. It hit resistance last week or so. Recently, that was back on the 11th, and hit it again. But there's certainly more if it wants to go up, and that's what the VIX does. When it starts to run, it can run. And then I shared that VXX trade a while back, and continue to, when I updated it, said, look, it still looks good. It was in a bullish falling wedge. And this wouldn't go until the markets broke. So once the markets broke, it's not coincidence that the VIX broke out of this, or VXX, I'm sorry. This is a way to trade the VIX. Since you can't buy the VIX directly, that's the VIX cash index you can't buy. You can only go futures, options on the futures, or one of these ETNs that turn around and invest in the futures. So here it is, VXX. It's moving up nice, since the lows, or well, let's just say since it broke out of that wedge, you're up about, 51%. And I think there's easily the possibility. Doesn't mean it'll do it, but certainly the potential. Here's my, right now, a near-term target, 55.12. But if we pop up, I have shares that I've been accumulating from here, and they're up pretty nice now. And I have stop loss order one just below there, and one that's like, I don't know where to have it. I have to look at my account. It's up here around 69 in the high 60s, just in case we pop there next week. And if the markets are down hard and Sunday night on the futures and Monday morning, I may pull the lower sell limit order and just kind of let it ride and wait till I can coincide and exit on this trade with a bottom when I see what's likely a bottom in the stock market. That's usually how I trade the VIX. I time it right in line with the where the market's going, as far as go long the VIX when the market breaks down, and go short the VIX. Cover that or close those positions when it looks like the correction's run its course. So I just wanted to point that out, that there is, as much as it's gone up 50% or so, there's still another 50+% upside potential in this thing. And if we're going to get it, I'll say this, it usually happens pretty quick. Once the VIX starts taking off, it just continues to go. So trade that as you want. Somebody asked me today, is it objective to add here? I don't know, because if we open up, if the market rallies next week, it's not my expectation, but if it does, trading the VIX is kind of like trading options. When they start to go against you, it will melt down like a hot knife through butter. So if the market started to rally, VIX can fall very fast. But again, that's not what I think is going to happen. But I want to point out that that's what probably would happen if we get a sharp rally somehow next week. But there's VXX, and you can see, nice resistance right here where it stopped today. It actually closed just a little bit above there, but again, it's the VIX, it's volatile. It's going to move up and down through these levels somewhat, but there's next couple targets for you. All right, guys, we're going to wrap it up here. Last chart of the day, NASDAQ 100 futures. Again, in the trading room, we were, actively trading these if you're a futures trader off the 5-minute charts today with some levels. But when you look at the bigger picture, here's the NASDAQ futures trend line going all the way back to early 2016, similar to the trend line I showed you on QQQ. And when you look at this chart, there was your most objective entry, and this is where we were following on the site. We had the breakdown of the QQQ as well as the NQ futures, and then set up with this little wedge as it was back testing, and boom. So that was that'll go down as the most objective shorting entry of the year. And we did the same thing back here and here. This was based on a 60-minute chart when we had a sell signal back there on the first drop, and then the second one also, I believe we based that off the 60-minute chart. And then this one was on the daily and 60-minute charts. And but when I look at this chart, the point being is look at that trend line. We're far from that trend line now, and very, very little chance of recovering it. So I think at best case scenario, you rally back. I don't even think when you usually get this far from a trend line, your chance to short, if you missed the initial short entry, was on the back test of that trend line. And so it was pointed out recently. Usually you get this far down, that's it. So that's my near-term and intermediate-term outlook. It's not very positive for the markets, but there's plenty of trading ops out there. If you don't trade short, if you don't like the short ETFs or shorting the market or individual stocks, I do think there'll be a long side bounce coming up soon, an oversold bounce. And there's also plenty of opportunities. That's what, on the right side of the chart. That's what we're looking at: treasury bonds, gold, alternative assets, commodities, and there's also stocks that tend to go up when the rest of the stock market falls. So that's how you navigate the next bear market, or even a big correction if we have a bear market already in play here. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.